Hello everyone. We will start tax reducer in this lesson, and now tax reducer is part of income tax, so we are still at income tax. Now in our income tax very first lesson, which was income tax pro forma, you remember we made the income tax pro forma. We have listed down all the sources of income. After listing out all the sources of income, at the end what happened is we calculated income tax liability. Now that is income tax liability which we have to pay to HMRC. Now before we pay to HMRC, we can reduce that tax liability by some means. Now them means are known as tax reducers. Now what are tax reducers? There are different types of tax reducers. We will study 3 of them today, and one of them, I mean the fourth one, we have already studied anyway, which is marriage allowance. Alright, so another 3 we will study in this video. Now what are these 3 tax reducers? These are investment companies. So when you buy the shares in these companies, so whatever amount you have invested in these companies, you will get some relief on that. Now these 3 tax reducers are enterprise investment scheme, seed enterprise investment scheme, and a venture capital trust. Alright, so EIS, SEIS, and VCT, venture capital trust. Now what happens is that these are different companies. When you buy the shares in these companies, you pay something, they give you shares. So when you buy the shares in these companies, whatever amount you have invested, you will get some relief on that. Alright, now let's move to our notes. If you have the notes in front of you, just go to your notes. In fact, I will just share the screen with you. Hang on. Here you go. As you can see on your screen, that is chapter number 1, income tax. Alright, now I won't go through all of this again. Just go on the bottom of the page. As you can see on your screen, I'll just excuse me, I'll just underline the words as well. I'll just share it. Here you go. As you can see on your screen, these are tax reducer just below the additional rate band. And it says use the following order. Now you must stick to this order. So first we will have to deduct 30% investment in VCT, which is venture capital trust, then from EIS, and finally from seed enterprise investment scheme. Alright, now only thing missing here is a tax reducer from marriage allowance, which we will also include here, but it does not come very often, so that's why it is omitted from here. Now these are tax reducers. Alright, I'll just cancel the screen. Let's come on the board. Alright, so these are 3 schemes which I have just shown you. One is EIS, Enterprise Investment Scheme. The second one is SEIS, and the third one is VCT. Alright, so EIS, SEIS, and VCT. Venture Capital Trust, Seed Enterprise Investment Scheme, and Enterprise Investment Scheme. Now these are 3 companies. So if you invest in these companies, now whatever amount you have invested, a specific percentage of that will be reduced by will reduce our income tax liability. Alright, so it is different for every company. Now as far as exam is concerned, our P6 exam is concerned, these are very, very important from theoretical point of view. Examiner won't ask you to do any calculation on these. However, he may ask you to do he may ask you to write something on that. All right. Excuse me. Alright, so these are very, very important from a theoretical point of view. So let's move to our topic. So first one is EIS, Enterprise Investment Scheme. Now it is a very small company, very tiny bit of company, and it want to raise some finance because it want to do some business. So what happened is it registered itself as EIS company. So when it registered itself as EIS company or Enterprise Investment Scheme company, then everybody comes to them and buy the shares because they see some benefit. Now when they buy some shares, they can do this company, this company can expand their business or start their business. Now what benefit is this company getting, EIS company? because ES company did not have any money to start the business, so they are getting benefit in shape of money and they can do the business. Now what benefit shareholder is getting who is buying the shares in this company? Excuse me, why would they buy the shares in this company? Now the government is giving benefit in shape of some relief. Now that relief in EIS case is 30% tax benefit or 30% tax reducer. Alright? So say for example, if you buy £1,000 worth of shares, 30% of that, which is £300, so your tax liability will be reduced by £300 in that specific year. Alright? Now is there any specific limit, or I can buy whatever amount of shares I want? No, there is a certain limit. So I will have to stick ourselves to that limit. For our current tax year, which is tax year 16-17, maximum I can buy the shares is £1 million. Alright? So maximum I can buy the shares. So if I want to invest, maximum I can invest is £1 million. So the maximum benefit I can get is 30% of 1 million, which will be £300,000, obviously. Alright? So the maximum I can get, maximum I can reduce my tax liabilities by £300,000. Another interesting thing is that in all of these three cases, the tax liability can only be reduced to zero. It cannot go into negatives. Alright? So the maximum these reducer will reduce the tax liability, it is to zero. It cannot go into negative because these are tax reducers. They can only reduce the tax liability to zero. They cannot create it into negatives. Excuse me. Now, although we know from our income tax pro forma that we can invest 30% of that, and I have already told you that the maximum I can invest is £1 million. But do I know anything about this company? Why would I invest in this company? I will have to know something about this company. So what is this company? This is just a small company, as I said, as I've already explained to you, that it is just a small company. So this is a small company. Size of the company is small company, means 250 or even less employees. Alright? Another thing is that it is unlisted company. So we know when it says unlisted, we know that it is a small company. So unlisted company, 250 or less employees. Another thing is that it is 16 million gross assets, less than 16 million or 16 million gross assets. Alright? So gross assets of 16 million or less than that, 250 or less employees, unlisted company. So all of them indications show that this is a small company. Alright? Now that was the reason when someone wanted to buy the shares in this company, they knew that this is a small company, only 250 employees obviously, so it is a small company. When it is a small company, it is unlisted as well, so we know what level of risk it is. Is it a small risk, low risk company, or a high risk company? What do you think? It is a high risk company, obviously. Alright, so it is a high risk company. When it is a high risk company, why would someone invest in this company? Because government is giving benefit, obviously. Alright, say for example, if there would be 0% benefit, would you be willing to invest in this company? I won't, because there is no benefit. I would rather invest in a listed company which will be secure at least, isn't it? Alright, but the government says that you will get 30% tax reducer if you invest in enterprise investment scheme. Alright, although we can invest in this company, but we will not get tax benefit, we will not get this 30% tax reducer until we have kept our shares for some specific period. Now that specific period is known as minimum holding period. So when I buy the shares, I will have to keep them shares for 3 years, minimum of 3 years. I cannot sell these shares before 3 years. Obviously I can sell the shares, but I won't get the 30% relief if I sell it before 3 years. Alright? Now if I sell the shares after 3 years, I will get 30% tax relief, which I have already taken anyway. Alright? Because relief will be straight away, but if you sell the shares within 3 years, it will be withdrawn. It will be taken off you. Alright? Now it depends. Say for example, if I bought the shares in EIS company, I kept the shares for 2 years, but then I thought I should just sell it. Alright? So when I first bought the shares, I got 30% tax reducer. So it was adjusted in my tax liability. But after 2 years, I'm selling it after 2 years, but I'm not keeping it for 3 years. Alright? So when I sold the shares, HMRC says, please give us back whatever you have already got in shape of tax reducer. So I've already got 30%. Alright? So I will have to pay it back to HMRC. But it depends how much I will have to pay back. It depends on the selling price. Now say for example, if I've sold it on the market value, on the market price, so when I sold the shares, I sold it on the market value, then whatever the market value was, I will have to take market value multiplied by 30%. Alright, so if I'm selling it after, I'm selling it within 3 years, then if I'm selling it at market value, I will have to take market value multiplied by 30%. So this will be, excuse me, this will be the amount which I will have to pay back to HMRC. Alright, now if I sell less than market value, then original relief, which was original amount, this amount, whole amount, and then original relief will be withdrawn. Alright, so original amount of relief will be withdrawn if I sell it for less than market value. Say for example, if I want to give it to my brother, then obviously he is my family member. I won't give him for on the market value. I will give him for less than market value. Alright, so if I give him for less than market value, then all of the relief originally which I obtained will be withdrawn. So if I give it for market value, then I will have to take 30% of whatever the market value was at that time, at time of selling. Excuse me, my throat has been itchy tonight, that's why I'm drinking water again. I'm sorry for that. Let's move to our second topic, second scheme, which is Seed Enterprise Investment Scheme. Alright, so SEIS. Now like other company, this is also a small company, but it is not just a small company, it is very small company. Although that company was small as well. You're gonna say, Faisal, that company was small as well. How about this one? This one is even smaller than EIS company. This has got only 25 employees, 25 or less employees. Alright, so it has got only 25 or less employees. So it means that it is a very tiny bit of company. So when it is when it has very less employees, 25 employees or just a small amount of employees, so when we know that it is 25 employees, it is a very small company. When it is a small company, it means that it is a very risky company, isn't it? Right? So likewise, that was a high risk company, we know that, but it is a high risk company, very high risk, even riskier than the EIS company. Alright, so let's go ahead and put this one here, that this is a very high very high risk company. Alright, although the earlier one was a risky company, but this is a very high risk company. Alright, now the maximum amount I can invest in this company is 100,000 pounds. Maximum amount I can invest in this company is 100,000 pounds. So I cannot invest more than that. Alright, so that is the limit told by HMRC. Alright. Now, by looking at the level of risk and the employees, and obviously if it is in that many, and it is also unlisted company. It is also unlisted company. It is unlisted company, 25 employees. What do you think? This one risky or that one? I have already told you that it is a higher risk company. Even that that was a high risk company, but it is more high risk than that one, because it is not only unlisted, but it has only got 25 employees. All right, so I hope you would appreciate the fact. Now, just looking at this information which I've already shown you, could you please tell me, if you had a choice, which company would you invest in? Saying there is nothing here, just think about it. Which company would you invest in? Yeah, I would invest in EIS company, because I don't know that how much the tax benefit is here. All right, so if it is, say for example, 30% here, say for example it is 30%, I will definitely go for EIS company. All right, but government says no, because you are taking extra risk, you are taking more risk by investing in SEIS company. You will get extra tax benefit as well. So tax benefit in this case is 50%. So whatever amount you invest in this company, 50% of that, which is massive amount, half of that, that will reduce your income tax liability. All right. In this case as well, you will have to keep the shares for 3 years. Likewise, like the previous one, if you sell the shares within 3 years, it depends on if you sell it for market value, then 50% of market value in this case, because it is 50%. So if you sell within 3 years, if you sell the shares within 3 years and you sell it at market value, then 50% of market value will be the amount which will be withdrawn by HMRC. All right. Now, if you sell within 3 years and you sell at less than market value, then the original amount of relief will be withdrawn by HMRC. Now, if you sell the shares after 3 years, then obviously nothing will happen, and the relief has already been given to you, so they won't take it back. All right. The last one is VCT, which is Venture Capital Trust. Now, the different thing is that it is listed. It is a listed company. All right. Now, it is, although a listed company, excuse me, although it is a listed company, but it is a listed company. But what happens here is that this company raises the finance, raises the money from general public by issuing the shares, but eventually this company is going to invest in these companies, right? So what happens is that this company is a company which has listed themselves, which has listed himself on the London Stock Exchange, but it is raising the finance, then investing in them companies, SEIS and EIS. All right, so what do you think? If you have to invest in VCT, SEIS and EIS, which company would you invest in? Knowing that this company, VCT, is eventually going to invest in one of these companies. All right. So what would be your preference? Could you please tell me? Obviously you can't tell me. You will have to tell your own self. I will guess you are saying that you will invest in these companies. Am I right? Or whichever. So what happens is that if you invest in these companies, all right, now this company is eventually going to invest in one of these companies. Now it depends on how much relief I will get, then I will decide which company I'm going to invest. All right. Now say for example I'm getting 30% relief, 30% tax reducer. Now tell me, which company are you going to invest? I would invest in this company, VCT. The reason being, this is a listed company. All right. Now you're going to say that although it is a listed company, but this company is eventually going to invest in these companies, then what is the benefit, even if it is listed or not listed? Now the benefit of listed companies, first thing is that it is a safe company, because we know that it is listed on London Stock Exchange. So before going to be listed on London Stock Exchange, they will have to they will have to go through too many regulations, rules. Too many rules, isn't it? So after fulfilling different requirements, only then they can register on London Stock Exchange. All right. So when it is listed on London Stock Exchange, we know that it is a less risky company. All right. Another thing is that when we invest in this company, this is just a single company. If we invest in EIS, it is just a single company. But when we invest in VCT, it is Venture Capital Trust. Now it is not only investing in just this company or this company, it will be spreading the money on different EIS and VIS companies. So they will buy some shares in this EIS company, some more shares in this EIS company, some more in SEIS, some more in another SEIS. All right, so they will be spreading the investment. Whereas if we have to invest our money in SEIS or EIS company, we will only invest in one single SEIS company and one single EIS company. But it is not doing like that. VCT is not doing like that, because VCT has got a lot of money from different people, so they are investing in different companies. So you know from your P4 or F9 studies that when you spread the investment, it is always wise to spread the investment because it will have less risk. All right, portfolio, if you remember. Excuse me. So what is the benefit if I invest in this company? 30%. And the minimum holding period, although in this case, excuse me, minimum holding period in this case, although, is a little more, which is 5 years. All right. We know it is listed company, so it is less risky because it is listed on London Stock Exchange. All right. Maximum I can invest in this company is £300,000. I am sure it is. Actually, I should check it on the notes. Actually, we will go through the notes anyway in the next video, so I will just leave it for now. So the maximum investment, we'll check it again with the notes, but I think it is £300,000. So the maximum investment I can do in VCT is £300,000. It is a listed company. Although when we know it is listed companies, we can say that it is a less risky company. So the tax benefit which I will get is 30% of the amount I have invested. So that will be the amount which will reduce my tax liability. Excuse me. All right. Now the minimum holding period in this case is 5 years. If I keep the shares for 5 years, then relief is already been given to me anyway. So the HMRC won't take it back. It won't be withdrawn. If I sell the shares within 5 years, then just I've shown you before in these two cases. So if I sell the shares within 5 years, then the relief will be withdrawn. All right. And if the relief will be withdrawn, but it depends on how much, at what price you are selling. If you are selling at market price, then 30% of market price. If you're selling at less than market price, then all of the relief will be withdrawn. Another thing in VCT is that dividend are tax-free in VCT. So the dividends which you get are tax-free. All right, so that is additional thing in VCT. Now in all of these cases, capital gains tax capital gains tax tax reducer also applies. All right. Now we were only looking at from the point of view, from the perspective of income tax till now, but if we talk about the capital gains tax, which is a different type of tax, we will also get relief, the same amount of relief in CGT as well. We will look at in detail when we move to our notes, but for now this is it. All right. I'll just wind up the video here. I'll just, my throat is very bad for now. I'll just take 5 minutes break. I'll take coffee, and then I will see you in the next video. All right. If you want to just note it down, and keep your notes in front of you, because we'll go through the notes in the next video. All right. I'll see you in the next video.